Hello, I'm Annabel Brody-Smith, Communications Director of the Association of Investment Companies. Elections, trade wars, Brexit uncertainty, and of course, most importantly, coronavirus have made 2020 a year like no other. Year to date, the FTSE All-Share is down 9%. However, the average investment company is up 11%. And up an even more impressive 51% since the market low on 23rd March. Despite the obvious concerns, there continues to be a healthy amount of secondary fundraising, and the industry has seen 6 new IPOs, raising $855 million. The industry's assets also reached a record high this year, quite an achievement considering the challenges it has faced. To discuss the past year and their outlook for the year ahead, I'm delighted to be joined by Joe Curtis, Manager of City of London Investment Trust, Simon Barnard, Co-Manager of Smithson Investment Trust, and Charles Plowden, Manager of Monk's Investment Trust. Right, on to the questions. What have been the winners and losers in your portfolio during the pandemic? And I'd like to ask that question to Charles.
Thanks, Annabelle. Our top 10 over the 12 months to the end of October were overwhelmingly from the new economy, led by Tesla, which was our best performer, but also with a very strong Asian e-commerce contribution from companies like Meituan, Alibaba, Sea, which is from Indonesia, and Japan's M3. Interestingly, Amazon and Alibaba, though, were the only mega platforms in the top 10, supporting our view that some of the younger companies, what we might call second generation platforms, are even more attractive than the giants. So Shopify and Sea are typical, and luxury goods platform Farfetch was also up there. Predictably, among the biggest losers were a Brazilian and an Indian bank, and we did sell the former, and a couple of energy related companies. But the biggest disappointment was Prudential of the UK, which we've held for many years for its exposure to the long-term growth in Asian savings. And while direct sales by the Pru were impacted by lockdown, and especially when they closed the border between China and Hong Kong, we would have expected the market to look through this short-term hiatus and to focus on the longer-term opportunity. So we remain fully committed to the Pru and see it as one of the most attractive stocks globally.
Thank you so much, Charles. Honestly, some of those platforms really have transformed our lives during this year. Simon, what have been the winners and losers in your portfolio during the pandemic?
Well, it probably won't surprise you to learn that several of our top performers were in the healthcare space. So our top performer overall was Ambu. This is a Danish healthcare company that makes disposable endoscopes. Now, endoscopes being, of course, the technical items that doctors use to look inside patients. Now, most endoscopes are reusable. That is, they're used on over 200 people before they're changed. They are, of course, cleaned in between procedures, but not always perfectly. So actually, there's been a rising incidence of infection. And that has obviously been a major problem during COVID, because you were seeing non-COVID patients actually catching COVID from endoscopes, which had been used on prior COVID patients. And also the people cleaning the endoscopes were also catching COVID. So what they discovered was that by using disposable endoscopes, which you just use once and then recycle, you can completely cut out this possibility of infection. Now, with Ambu being by far the largest producer of disposable endoscopes, they significantly benefited over this period with their demand up 70%, that's 70%. We also had a healthcare company in the US called Masimo. They make sensors, and they're normally deployed into intensive care units. So as those intensive care units grew, so too did their sales. They also produce sensors which they were able to attach to patients who they could then monitor remotely. So patients could either wander around the hospital or even better, go home and save hospital beds. That too proved very popular, pushing up Masimo's share price. And finally, we had a healthcare company based in New Zealand called Fisher & Paykel Healthcare. They make respiratory equipment, which was obviously in very high demand. In fact, so much so that Fisher & Paykel had to delay their full year results in 2020, simply because there were so many people within the company manning the phones to customers or on the manufacturing production line that there was simply no one left to do the reporting, to put out the annual report, which we found quite impressive. We also had good performers among some consumer companies, in particular Domino's Pizza, which we own the franchise in Australia. They also have a couple of European markets, and they benefited a lot from this stay-at-home trend, as well as a lot of the competing restaurants, of course, being closed during lockdown. Now, in terms of detractors, the companies that really hurt our performance, we only had a couple. By far the worst performer in our portfolio was a company called Sabre. This is a US software company that is related to the travel industry. They connect travel suppliers like airlines and hotels to travel buyers like travel agents and consumer websites such as Expedia. Now, their revenue is directly linked to passengers boarded on planes or booked into hotels. So as passengers fell over 90% at the peak of the crisis, so too did their revenue. Now, unfortunately, this is one of the very few companies we own that actually has any debt, perfectly manageable in a normal operating environment. But of course, if your revenue falls 90%, pretty much any debt is going to be a problem. Now, we were very concerned about this company and did an intense amount of work on it in a very short period of time. I remember even waking up at 3 a.m. thinking about this company. But what happened was that the management team managed to very quickly cut costs within the business, as well as return to debt markets to raise over $1 billion of debt capital and $500 million of equity capital, which enabled them to provide enough liquidity for that company to survive with almost no revenue for the next 2 years. And after that was done, we felt a lot more confident holding that company. In fact, we added to it quite close to the lows, and it has since recovered. Another company that didn't do too well during the crisis, which is one that many will have heard of, is Fever Tree Drinks. This, of course, did poorly because with bars and restaurants closed, people were worried that they wouldn't be able to sell much tonic. Actually, half of their business is done through what we call off-trade, which is supermarkets and grocery stores. And actually, that almost went up to compensate. So we discovered that although Fever Tree, the share price did perform quite poorly for a short period of time, it's now actually beyond where it was in January, February, simply because tonic sales have recovered very quickly.
Thanks so much, Simon. Pizzas and healthcare, what you needed in the pandemic. I have to say, I might have bought some of those bottles of tonic from Fever Tree during lockdown. Joe, what have been the winners and losers in your portfolio during the pandemic?
Well, the consumer staples sector has been a winner through the pandemic. And these consumer staples I define as makers and sellers of essential goods. And to really highlight two stocks which City London owns within that category, Reckitt Benckiser, which has a big health and cleaning division. I mean, they make Dettol, and many households, including my own across the country, have been spending a lot more on Dettol wipes and sprays. And, they've really benefited. And also within consumer staples are the sellers of essential products like the supermarkets, and certainly Tesco's and Morrison's, which we own in City London, have both done well, and they're now paying back their business rates relief, and they've carried on paying their dividends. And there's been a trend away from the discounters relatively, and more as people do one big shop, more back to the big supermarket groups. And in addition, the big supermarket groups have got their home delivery sorted and are much more competitive now on that. So that's been the good area. The worst area really has been travel and leisure. I mean, they've been at the absolute eye of the storm. We've had to reduce our exposure. And unfortunately, I do think dividends will take a long time to return because with social distancing, the recovery is going to be slow in the travel and leisure sector. And in addition, many of the companies have taken a lot of money from the government, which they needed, the furlough scheme and various loans, etc. And as a result, they have to repay all that before they can start paying dividends again. So sadly, I think that's going to be a sector which will be quite slow to recover.